Return on equity, or ROE, is a crucial financial ratio that investors and analysts closely watch. It tells you how efficiently a company uses your money to generate profits, essentially measuring the profitability of a company in relation to shareholder equity. Think of it as a report card for management's performance, showing how well they are using the resources provided by shareholders to generate earnings. A high ROE generally suggests that the company is using your investments wisely, indicating strong financial health and efficient management. ROE is expressed as a percentage, making it easy to compare across different companies and industries. It shows how much profit a company generates for every dollar of shareholder equity, providing a clear picture of financial performance. Shareholder equity represents the company's assets minus its liabilities, essentially the net value owned by shareholders. In essence, it's the company's net worth, reflecting the residual interest in the assets of the company after deducting liabilities. Understanding ROE is essential for investors because it provides insight into how effectively a company is using its equity base to generate profits. It helps you assess a company's profitability and growth potential, which are key factors in making investment decisions. By analyzing ROE, you can make more informed investment decisions, ensuring that you are putting your money into companies that are likely to provide good returns. So, next time you evaluate a company, don't forget to check its ROE to gauge its financial health and management efficiency. Calculating ROE is straightforward. The formula is ROE equals net income divided by shareholder equity. Net income is the company's profit after all expenses are deducted from revenue. Shareholder equity, as mentioned earlier, is the company's net worth. You can find both net income and shareholder equity on a company's income statement and balance sheet, respectively. These financial statements are publicly available for publicly traded companies. By plugging in the numbers from these statements, you can easily calculate a company's ROE. This simple calculation provides valuable insights into a company's financial health. Let's say company XYZ had a net income of $10 million last year. This figure represents the company's total earnings after all expenses, taxes, and costs have been deducted. It's a crucial indicator of the company's profitability and overall financial health. Its shareholder equity was $50 million. Shareholder equity is essentially the net value of the company, calculated as total assets minus total liabilities. It represents the owner's claim after all debts have been settled. To calculate ROE, we use the formula ROE equals net income divided by shareholder equity. This formula helps investors understand how efficiently a company is using its equity base to generate profits. ROE equals $10 million divided by $50 million. By performing this calculation, we can determine the return generated on each dollar of equity invested in the company. ROE equals 0.20 or 20%. This percentage is a key metric for investors, as it indicates the efficiency and profitability of the company in generating returns from its equity. This means that company XYZ generated a 20% return for its shareholders. In other words, the company has been able to turn each dollar of equity into 20 cents of profit. In other words, for every dollar of shareholder equity, the company generated 20 cents in profit. This is a strong indicator of the company's ability to create value for its shareholders. This example illustrates how ROE quantifies a company's profitability. It provides a straightforward way to assess how well a company is performing financially. It provides a clear picture of how effectively management is using shareholder investments to generate returns. By analyzing ROE, investors can make more informed decisions about where to allocate their resources for the best potential returns. A higher ROE is generally better. It suggests that the company is using its equity more efficiently to generate profits. However, there is no magic number for a good ROE. As a general rule of thumb, an ROE of 15 to 20% is considered healthy for many industries. However, it's crucial to consider industry averages and historical trends. For example, a high-growth technology company might have a higher ROE than a mature utility company. It's essential to compare apples to apples when analyzing ROE. Section 5. The power of ROE. Why it matters for investors. ROE is a powerful tool for investors. It helps you assess a company's profitability, efficiency, and growth potential. A high ROE can indicate strong management, a competitive advantage, or efficient operations. It suggests that the company is generating good returns on investments. Conversely, a low ROE might signal problems such as poor management, high debt, or a lack of competitive advantage. Investors should investigate further to understand the reasons behind a low ROE. Section 6. Unpacking ROE, the DuPont analysis. The DuPont analysis is a useful tool for dissecting ROE. It breaks down ROE into three components: net profit margin, which measures how much profit a company makes for every dollar of revenue; asset turnover, which measures how efficiently a company uses its assets to generate revenue; and equity multiplier, which measures how much debt a company uses to finance its assets. By analyzing these components, investors can gain a deeper understanding of the drivers behind a company's ROE. It helps identify strengths and weaknesses in a company's operations. Section 7. Red flags. When high RO isn't so rosy. While a high RO is generally desirable, it's essential to be aware of potential red flags. A high RO might be misleading in some cases. For instance, a company with excessive debt can artificially inflate its ROE. This is because debt increases the equity multiplier, one of the components of ROE. Additionally, a company might achieve a high ROE by taking on risky investments. While this can lead to high returns, it also increases the potential for losses. Section 8. Industry insights, RO benchmarks. ROE can vary significantly across industries. It's important to compare a company's ROE to its industry peers to get a meaningful assessment. For example, capital-intensive industries like utilities tend to have lower ROEs than industries with lower capital requirements, such as technology. Investors should consider industry benchmarks when evaluating ROE. This provides context and helps identify companies that are outperforming or underperforming within their respective industries. Section 9. The bigger picture, using ROE with other ratios. RO is a valuable metric, but it's not a standalone indicator of a company's financial health. It's essential to use ROE in conjunction with other financial ratios for a comprehensive analysis. Some ratios that complement ROE include debt-to-equity ratio, which measures a company's financial leverage, current ratio, which measures a company's short-term liquidity, and price-to-earnings ratio, or PE, which measures a company's valuation relative to its earnings. By analyzing ROE alongside these ratios, investors can gain a more holistic view of a company's financial performance and position. Section 10. ROE limitations, not a standalone metric. While RO is a powerful tool, it's important to acknowledge its limitations. ROE is based on accounting data, which can be subject to manipulation. Moreover, ROE doesn't account for risk. A high RO might be achieved through risky business practices, which are not reflected in the ratio itself. Investors should be aware of these limitations and use RO as part of a broader analysis that includes qualitative factors, such as management quality and competitive landscape. Section 11, the bottom line, RO's significance in financial analysis. Return on equity, or ROE, is a crucial financial ratio that provides insights into a company's profitability and efficiency. It is one of the most widely used metrics by investors and analysts to gauge how well a company is performing in terms of generating profits from shareholders' equity. It measures how effectively a company uses shareholder investments to generate profits. Essentially, ROE indicates how much profit a company can produce with the money shareholders have invested. A higher ROE suggests that the company is more efficient at converting the equity financing it receives into profits. Investors can use ROE to assess a company's financial health, growth potential, and management quality. A consistently high ROE can indicate that a company is well managed and has strong growth prospects. Conversely, a low ROE might signal potential issues with management or underlying business problems. However, it's essential to consider industry benchmarks, potential red flags, and other financial ratios for a comprehensive analysis. ROE should not be viewed in isolation. Comparing a company's ROE to its industry peers can provide a clearer picture of its performance. Additionally, sudden changes in ROE can be a red flag, indicating potential issues that require further investigation. While ROE has its limitations, it remains a valuable tool for investors seeking to make informed investment decisions. It's important to understand that ROE can be influenced by various factors, such as debt levels and accounting practices. Therefore, a thorough analysis should include other financial metrics and qualitative factors. By understanding ROE, you can gain a significant advantage in navigating the complex world of finance. It equips you with the knowledge to evaluate companies more effectively, helping you to make better investment choices and ultimately achieve your financial goals.